the biggest shift in global finance isn't happening on Wall Street. It's happening on a blockchain most people have never heard of. Stocks, bonds, gold, real estate, they're all starting to move on chain, settling in seconds, trading 24 hours a day, 7 days a week. The question isn't whether this is coming, the question is who is building the roads? Welcome back to Crypto Clarified. I'm Davila Shlinskite, Director responsible for digital asset research at WisdomTree Europe.
And my name is Vin Tran, responsible for business development at WisdomTree Digital Assets.
And today, we have one of those road builders with us, AJ Warner, Chief Strategy Officer at Offchain Labs, the team behind Arbitrum.
Hello, AJ. Welcome to the podcast.
Hey, thank you so much for having me. Really excited to be here.
Absolutely. We like to kick it off with some fun questions. I know you are a self-described food lover. What's the best meal you've had at a crypto conference, and what city has surprised you?
The steak in Argentina was fantastic. That was like my first time in Buenos Aires, and I think I was like extremely pleasantly surprised by the meat. So I think Argentina wins.
We were just talking about this before, Davila, that what is my dream conference? I think I have to change my answer. With Singapore, maybe it is Argentina.
Singapore Token 2049 is fun too. It's like obviously huge, but Argentina was charming, I would say.
Yeah. I've heard. All right, talking about cities. I know you're from Toronto. We
Yep.
share of the similar vibe, being that I'm from New York City. A lot of people don't know this, but you are a hockey analytics writer for the Toronto Star early in your career. How does one go from hockey analytics to what you do today?
I mean, my journey to be writing hockey stuff, and you can probably see it in my background on the wall. That was my first article. It was actually pretty funny. So I was like, when I was in college, I used to, I love hockey. It's like my favorite sport. At one point, I thought I wanted to be either a sports writer or sports agent, one of those two things. I really like the intersection between economics and sports. Um, there was one of my favorite players on the Toronto Maple Leafs was going through like a very controversial contract negotiation, and the consensus was that he was worth a lot less than people thought he was gonna get paid. So I just, like, cold called the editor of the Toronto Star, which is the largest paper in Canada, and said, "I've got, like, a really strong argument. Here's 30 seconds why I think that the consensus is wrong, and he's a much more valuable player." Yeah, I like the story. He's like, "If you can get me 2,000 words in the next 48 hours, I'll publish it." So I was like, "Wow, that took a way that went a way I didn't think it was gonna go." Um, and then basically I sent him, like, an article. He's like, "Okay, it's gonna go in the Tuesday paper," whatever it was. I think it was Friday, actually, to be honest. And um, all of a sudden, like, it was just there. They asked for like a profile picture of me. They had me like it started in the front page of the paper. It's the largest paper in Canada. And then I just started writing a few things. I wrote for a few different outlets. I realized very quickly that I really didn't enjoy the editorial process. Like, I like to express my thoughts, but you know, the idea of getting sensationalized, not being able to really approve, and every word that you write that's attached to your name, I thought was very not my style. So I kind of put that on pause. The funny thing is that, and this is going to tie it to crypto, is that one of the things that I found most challenging is, like, at the time I had like maybe 4 Twitter followers, but all of a sudden I was getting like a ton of Twitter hate. And I think that that might have prepared me for the future of working in crypto, where that's sort of like the bazaar, the marketplace of thought, and you have to develop thicker skin. So I think, fortunately, I probably developed a little bit thicker skin searching my name earlier than I would have expected when you write controversial hockey stuff in Canada.
I'm sure the passion is very similar. If anybody spends any time on crypto Twitter, they know exactly what you're talking about. So that's a good segue. If last fun one actually before we dive in, but it kind of relates. If you had to explain Arbitrum Offchain Labs, what you do to your parents, what would you say? Or what analogies do you use?
Oh, that's funny. So I remember, and this goes back to sort of when I quit my job. So in between doing the sports stuff, I was a real estate lawyer for 5 years at a law firm in New York doing development. Um, and that was like the kind of thing that made my parents very proud. And in 2020, telling them I was going to work in crypto was like extremely confusing. And nerve-wracking for them. Um, the Alchemy, the crypto infrastructure company, has a shirt which basically just says, "Mom, I work for Bitcoin," or "Work in Bitcoin." That was kind of like how the conversation went. I remember when I told them at first, um, but I just basically tell them now, and I think this is like sort of where we are as a company. Is, and I'm sure we'll discuss this to some degree. Is we're building a financial infrastructure from a software perspective that will power sort of the next wave of financial innovation and efficiencies. And I think my parents kind of get it. They kind of don't get it still, I think, for a lot of stuff. But at least we're in a position now where I think it's the industry has significantly improved from a credibility perspective, where people who are less familiar with it kind of view your participation in it in a more positive light. But it was a fun conversation. I still remember vividly. It was it was in the middle of COVID. I just had my second child. She was like three weeks old. And that's when I gave notice. And I just remember like there was a lot of upheaval, but I was pretty close with Steven, our CEO, and I got to know Ed and Harry, and I was very passionate. I can talk about sort of how I got into crypto a little bit if it's interesting, but I'm very passionate about the industry for a while, and it was like a now or never moment to kind of jump in and chase a passion. So I took it, even if the circumstances were a little bit interesting or surrounding it from like a world, I guess, macro perspective.
I love this. When the world is collapsing around you and when you have a second small child, let's make more change. So,
Yeah, exactly, right? I mean, yeah, it's it was the company was just about to launch the alpha test net. We're getting off the ground. Ethereum was, it was right after DeFi summer of 2020. Ethereum was really starting to see congestion. If you kind of like look at where the world is today, I think people forget sort of how much Ethereum has scaled, particularly via layer twos and almost a little bit of layer one. But like now a layer one transaction is in the tens of cents. A layer two transaction is sub penny. It was not uncommon for a layer one transaction to be $30. You know what I mean? Like I think people kind of have underappreciated the level of scalability that's happened even in, obviously it's been about 5 years, but um, yeah, it's crazy. So the problem set was very obvious and intuitive to me. It's obviously intuitive to the company as well, but it's been amazing to see the progress that's come in, and we can talk about all the reasons for why people are launching their own chains, etc., as part of this. But I think the core thing that needed to be solved 5 years ago was scale. Um, and I think if you look today, it's been pretty clearly solved. We're in a significantly stronger position to be able to have 100x throughput whenever is necessary compared to where the industry was, let's say, um, five, even 3 years ago.
I think you just mentioned the keyword scale, and I think you have been super successful in gaining scale in the market that you operate in. Do you mind walking our listeners through how you managed to do that? Because when you start from nothing and build out one of the most successful things, like how is that achieved?
Yeah, so I'll actually walk you through the history and story of Offchain and how it got started, because I actually think it's a
Yes.
really helpful story for your listeners. So, the three founders, just by the way, just to briefly introduce myself and my role, I lead the business development and corporate development components of the work at Offchain. So that's the Arbitrum product, the ability to launch your own chains, etc. That's kind of like the business side is where I sit and where I focus. But Ed, Stephen, and Harry, who are the three founders, all have technical backgrounds. Ed was a professor at Princeton, and Stephen and Harry were his PhD students in the computer science department. Um, when the first smart contracts were being designed, and this is like late 2013, early 2014, one of the things that Ed noticed very quickly was if we wanted to maintain the principles of security and decentralization from a consensus perspective, you're probably going to need what we now call today layer two architecture in order to be able to scale. And if you look on YouTube, and it's, it used to be easier to find, but now there's obviously a lot more Arbitrum mentions. The first mention of Arbitrum was actually the final project of Ed's class in fall 2014. They built it on top of a hypothetical layer one. They used Bitcoin. Obviously, it couldn't support smart contract functionality, but this is before Ethereum even launched. Ed and his team, Stephen and Harry, were thinking about blockchain scalability. The scalability trilemma, which is this idea of, you can have two out of three things: security, decentralization, and scale. And how can you solve it? And obviously, a layer two architecture design like Arbitrum and Ethereum is one example of that. Ed then went to the White House. He was Obama's deputy CTO. When he came back in 2018, back to Princeton, it was the first time Ethereum started congesting because of the CryptoKitties launch. And Stephen and Harry went into his office and said, "Remember that thing from fall 2014? Let's build that." And that's when the company was founded. Ed gave up his position as a professor, tenured professor at Princeton. Stephen and Harry joined, and they led. I was working with them in sort of like an advisory capacity at the time, and I joined obviously full time about 18 months later. But that's really how long the team at Offchain has been thinking about what you described as scale. How can we improve on the scalability of blockchain architecture? Obviously, we're building on top of Ethereum, which is the choice that we've made in terms of the ecosystem we want to build with, the ecosystem we want to scale. At Offchain, obviously, our most famous product is Arbitrum, but we're also actually the largest core contributing team to Ethereum, I believe, outside of the Ethereum Foundation, because we build Prism, which is the consensus client of Ethereum. So we're pretty heavily invested in the success and the vision for the future of what Ethereum is, and obviously that started with scale. And I can walk you through the technical architecture if that's helpful for your audience in terms of how it works as well. Just very briefly, the way it works is if you use Arbitrum or if you use any of the chains, for example, the Robinhood chain that's built on top of the Arbitrum technology stack, it looks like you're interacting with a separate blockchain, right? We expose the blockchain the same way any EVM network is exposed. But what is happening under the hood is every transaction is then posted to Ethereum and settles on Ethereum. And Ethereum is like the inherent security mechanisms of the chain from a consensus perspective is rooted in Ethereum. So we don't have our own validator set that is staking, for example, to secure the Arbitrum network. We outsource that and we rely on the Ethereum validator set, which is a huge technical advantage and business advantage that layer 2 architectures offer because you don't have to bootstrap your own validation. So Ethereum plays a critical role in the security and the settlement of Arbitrum blockchain platform.
That's super helpful. And I also want to double click on the trilemma issue that you mentioned. You talk about decentralization, and I know there's a lot of confusion, oftentimes with non-crypto native folks about what's the difference between the lab piece and then the foundation, right? And you hear that often in the news, right? Can you describe that relationship between how you operate at Off-Chain Labs and then how that impacts? You mentioned the product being Arbitrum, but then I know there's a foundation behind that as well. How do all three kind of piece together?
Yeah, so the way to think about this, and a lot of this is again obviously um a function of sort of operating in a world in which there isn't complete regulatory clarity around how everything gets set up in different jurisdictions, right? So when the Arbitrum Foundation and the Arbitrum DAO and governance was established in 2023, there was certainly a lot less clarity, no pun intended, for how these business architectures should be operated and should be stood up. Um, Offchain is largely the core team that's developing the technology. And the way to think about this is the foundation is largely the stewards that represent the underlying technology. And this is true. I can talk you through Arbitrum. The exact setups are very different, for example, in different ecosystems as well, because again, both from a legal guidance perspective and also from a business perspective, people have been trying different things. Um, the Arbitrum Foundation actually has a lot less, I would say, power and control compared to other foundations. In Arbitrum, the power and control actually stems from the token holders. And what do I mean by that? Every dollar of revenue that is generated by the Arbitrum protocol automatically flows on chain into a treasury wallet controlled by the Arbitrum token holders. The foundation cannot move it without a token holder vote. Off-chain can't move it without a token holder vote. In order to get those tokens to move, there has to be an on-chain vote approved by the majority of the token holders, and it also hits sort of the quorum threshold that is necessary. And that is a very important distinction, and it relates a lot to the Arbitrum architecture. it might be helpful to take a step back and walk through, in my opinion, one of the biggest structural differences between a layer 1 and a layer 2 architecture. From an economics perspective, not from a technical perspective, but they're quite related. From a technical perspective, one of the core differences, which is what I mentioned earlier, is whether or not you need to bootstrap your own validator set. And why does that matter? In a proof of stake system, if you're bootstrapping your own validator set in order to inherit the security and decentralization from that distributed set and collection of actors, you need to incentivize them in order to be able to continue to operate this function, right? And if you kind of look at the layer 1 blockchain peers that Arbitrum might have, they are generally spending between $1 and $500 million a year in order to incentivize those validators to continue to validate the network. And they do that usually in the form of inflationary rewards of the underlying token asset, right? So they might have a native yield, might be 5%, it might be 6%, it might be 7%, but the mental model really is that is outside of Ethereum and to a lesser extent Solana, that is overwhelmingly being funded by an inflationary reward in order to maintain that. Arbitrum, as a layer 2 technology, does not have an inflationary mechanism to pay for security. How does Arbitrum inherit its security? How does it get adjudicated and rely on the Ethereum validator set for its security? What happens is for every dollar of transactions, about 2 cents get paid to Ethereum layer 1 for settlement, and then in essentially adjudication of what is considered the correct state. So Arbitrum's security budget is variable with extremely low fixed costs. I think the fixed costs that we have is like $11 a day that we have to pay for Ethereum. If there's no transactions, it's something in that range. It's an insignificant amount. But the amount that you pay scales with the amount of usage that you have, right? Which is a significantly easier business model to underwrite from a cost perspective versus, okay, I have a fixed costs of 100 million. Then I have transaction fees on top of that, which will hopefully offset it, etc. It's much harder to bootstrap the launch of a layer 1 than it is to launch the layer 2. And I think that's why a lot of enterprises have chosen layer 2 architecture. That's point number 1. It's the fixed cost versus variable costs. The second point is, and this is a really important question, is, okay, both layer 1s and layer 2s collect blockchain fees. Where do they go? Right? So in a layer 1 architecture, and again, this is really true across the board for layer 1 blockchains, the fees get passed through to the validators, right? So if you, and this is, I think, in some ways where Ethereum's, shined in 2021, struggled in 2023, and is getting sort of repriced today, every dollar that moves through flows automatically to the validators. That's how layer 1 blockchains work. For most blockchains that are trying to bring their inflation down of their fixed costs, they welcome that, because if they can get $100 million in transaction fees and then submit a proposal to reduce the natural inflation rate because it's no longer necessary to compensate validators up to a certain level because they're getting compensated by actual usage of the systems, that's like a great outcome for a layer 1 blockchain, right? Ethereum has crossed that chasm. To some degree, Solana has. The community is currently debating that within Solana, whether they should have the natural inflation rate come down. I think other than Ethereum and to some extent Solana, you really cannot argue that any other layer 1 smart contract platform has crossed that chasm today. So that's where the fees go. The example that I like to give for how layer 1 blockchains operate is it's much closer to like how a REIT would operate, a real estate investment trust, where basically it passes through all of its cash flow in order to be able to just pass through. Usually in the case of a REIT, it's for tax purposes, but that's how they operate, right? Nobody invests in a REIT really as like a high growth business, because usually if they want to buy another building, they have to raise primary capital or from a mechanism. They don't get to retain capital for growth. Layer 2 blockchains operate very differently. I think to date, Arbitrum is the only one that has fully implemented this, where the revenue goes to the token holders. But for every dollar of transaction on the Arbitrum network, The 2 cents, like we said, approximately 2, it depends on the price of 4844 blobs. That goes to Ethereum. And the question is, what do you do with the other 97.98 cents? In Arbitrum's case, is it goes into the treasury of the token holders. The reason why this is a structural difference is it gives you both a mechanism and a vehicle to actually reinvest in growth, right? So we don't have to pay inflation rewards. Every dollar that's generated in revenue, as well as the existing token treasury, can actually be utilized in a growth vector versus sort of like a high fixed cost, high pass through business model. Much easier for startups to operate. This governance layer, though, where the on-chain treasury really is where the funds flow, also allows us to get a lot more creative in how we think about off-chain and on-chain business growth beyond purely transaction fees. And I'll give you a good example of what I mean. The Robinhood chain launched, I guess, at the beginning of this past month. I think it was either end of June or beginning of July. I can't remember anymore. I think it was beginning of July. And it's been a smashing success, right? I think it was the fastest blockchain to 100 million transactions. They've been generating a few $100,000 a day in transaction fees, hundreds of millions in TVL. Really, it's been like one of the most successful launches. They're using the Arbitrum technology stack. The way we've architected our business model is that Arbitrum the token holders get a 10% revenue share with the usage and the fees generated on the Robinhood chain platform. So if Robinhood chain is doing, let's say, $10 in transaction fees, they pay Ethereum 2 cents for that. Let's just say, for example, or 20 cents. Out of the 98% that remains, 10% goes to Arbitrum. So what does it mean to go to Arbitrum? Because we have this whole governance and treasury layer and architecture already built, controlled by the token holders, it can just flow into that token treasury. So you can have business functions that are actually controlled and enabled either on-chain or via third parties that are doing things that can flow directly into token holders in a way that an L1 consensus and transaction mechanism cannot, because those systems are much more designed for pass-through, right? And you have the questions of buybacks versus burn versus retention. My position, and I think obviously the token holders can vote to do something different, is that Arbitrum should be heavily investing in growth to continue to get the amount of assets that live on the platform up, the number of enterprises using the technology up. We're expecting this industry to grow significantly. We're trying to see every asset in the world tokenized. This is not the time to think about burning the mechanism, redistributing capital. This is the time, from my perspective, on a personal level, to think about growth, to how to invest heavily in growth. L2 architectures, I think, are significantly better designed from an on-chain control perspective to be able to do this than from an L1 architecture where, yes, the foundations can act to grow the networks, but if you think structurally about how economics are returned, it's actually very hard to have compounding effects on revenue. So I know I just spoke for a very long time. You probably have a bunch of questions as a function of that. But I think that's a very high level point, which, to answer your specific question, is that Arbitrum was intended to be designed that the revenues flow into a treasury controlled by token holders. That is the source of power. The changing of these parameters can also only be done by Arbitrum token holders. For example, we raised the base fee on the public Arbitrum chain last year. That cannot be done unilaterally by Offchain. It could not be done unilaterally by the Arbitrum Foundation. That required an on-chain token holder vote in order to be able to actually submit that, because these functions cannot change otherwise. So that's the way to think about it at a high level.
I loved this response, absolutely loved it, because what I'm doing now is I'm writing a new white paper that hopefully will get published by the end of this year or the start of new year, where I'm trying to outline how investors need to think about altcoin valuation. And you are the person who talked about this now very, very clearly. So thank you for that. I'll make sure to include the links to our episode in that white paper.
Sure.
But
Happy to be a resource. Thank you.
thank you. But one question that comes to my head is, over the past couple of years, we have seen a lot of positive change in regulation. especially in the US. So have these changes opened any new doors for Arbitrum, for what you can do, what you can build, where you can grow?
I think to some degree, yes. I think I think we have to wait to see when it gets into law and what the rules and regulations will look like for people to understand. But I think that one of the things that we have seen is probably more of a willingness to actually ensure that there's a sustainable business model, right? So we've tried to do this from the beginning. I think that if you look at some of sort of the other very strong, projects across DeFi and other verticals, they are probably a little bit more hesitant. And I personally don't think that for most projects, overwhelmingly, I can think of maybe one or possibly two projects in crypto that buybacks or burn makes sense as a primary strategy today. Almost overwhelmingly, nobody has enough revenue for it to be doing that. Like if we were talking about any other vertical, high growth companies, early stage industry, every traditional investor, every venture investor, they just want to see like, well, what is your growth? What is the TAM of the industry? Where do you see this being in 5, 10 years? People don't really want to know like, okay, what is my, IRR in the next 18 months, right? So I think that what will be required to change is the business models and also the patience of capital. One of the problems I think that crypto had historically, and I think this has largely gone away through the last market downturn, is that opportunity costs of investment and liquidity were very high for investors, right? So it required projects that were trying to build for the next decade to probably move in a more accelerated fashion to return capital to investors. Because, another project could just slap a token, launch, and everybody gets liquidity in 18 months. And I think that sort of the industry has changed where like this idea of like, oh, I'm just going to launch a token is like insufficient for investors to be excited about. They want to see innovation, they want to see growth, they want to see revenue, they want to see users, etc. And I think we're starting to see a lot of downstream trickling effects of what that means for both the patience of investors, the consolidation of capital into the strong 15, 20 best businesses in the industry. So I think that the regulation, the clarity, the sustainability of business models is going to have more downstream effects on the capital markets, which I think will reinforce um, investment into, I think, the strongest organizations and opportunities that the industry has to offer. So I don't know if that directly answers your question. I think the short answer I would say is it's a lot. We have a lot more to learn still, but it has allowed us to look at things. But the biggest effect I think will come from the um, the forms of capital that we're looking to deploy. I think more patient capital will be looking to redeploy into the industry as more clarity, um, as tokenization continues to grow, as people understand where the value can be generated and earned and returned as a function of that. So I think that's probably where I'm most excited about. If you look at sort of crypto capital sources today, um, there's very little growth funding, right? So if you're an AI Series F company, there's plenty of people that will be deploying. In crypto, you don't usually get there out of business other than like, maybe regulated infrastructure businesses like an exchange or a stablecoin issue or something. But on-chain businesses, either they usually have the token in advance, in which case the whole funding model has changed, or they're supposed to be sort of finalizing plans earlier. I think the capital base is going to change, which I think will change how people think about business models as well.
Yeah. And you touch on so many things, and honestly, AJ, you're kind of doing our job for us. I feel like you've touched on all my future questions. So you mentioned Robinhood, Hood Chain, you mentioned innovation, you mentioned the idea of patient capital, and I think a lot of that converges into what, at least you and I have had many conversations on what innovation looks like in the space. Obviously, within the U.S. at Wisdom Tree, we focus very much on the RWA side, and I know that Offchain Labs, Arbitrum in general, in terms of what you're focusing on has been recently a lot of that is RWAs. And then the term that I think you brought up is programmable economy. Like what does that really mean in practice when it comes to things like a Robinhood, right? Like, what do you think that unlocks from an innovation standpoint, from a scale standpoint? Because I think we're seeing the same issues that you are seeing, right? This desire for new types of capital on chain, and how do we really bridge that? Um, and obviously, we could talk about that gap for hours, but would love to get your thoughts on kind of all the things that we just mentioned together.
Yeah, so I think the idea of the programmable economy and something that we've been focused on building and how we think about this is how do we get to a place where the root of trust in financial markets can be enabled and or enforced by software, right? So obviously the institutions that sit behind these assets, like Wisdom Tree, for example, play an absolutely critical component in the onboarding and the issuance of assets. But the question is about what efficiencies can be enabled, what can be unlocked as a function of the movement of these assets becoming programmable. I think there's sort of two vectors there. The first is trust, right? I think people still want to understand that like they can have control of their funds in software. I think that that's something that is like not 100% intuitive to people today, but there are certain moments in time where either there's people are locked out of their funds or there's internet goes down, whatever it is, people sort of want to ensure there's bankruptcies or whatever triggering event happens, let's say once in a decade. I think that that is something that trust is very important. I think that's one of the promises of decentralized blockchain technology. I think, sort of as sort of tokenization has moved to the forefront of a lot of the conversations, sometimes people forget, like, why are we building on these systems in the first place instead of just building on centralized rails? And I think trust, sovereignty is a critical component of it. I do think though that compared to sort of um and I've spent a lot of time advocating for this, that I think if in the Ethereum community, ETH's role is very underestimated, sort of as this decentralized medium of exchange or currency. I don't think most people are looking to hold a tokenized asset issued by Wisdom Tree or even a stable coin issued by Circle in place of a decentralized money, right? Like that is not like you're not going to hold, a money market fund issued by a regulated entity that has the rights to blacklist or et cetera, which they need from a regulatory perspective. That's not like the sole reason to be using blockchain technology. The second thing that it unlocks is, in my opinion, the creativity and composability that shared backend infrastructure can provide. And I think that is one of the most critical components of what blockchain architecture can unlock and enable efficiently. So if you think, for example, about this idea of, let's just take tokenized equities. If you have tokenized equities that are permissionlessly available in the backend that can be utilized for people to expose to their users, you have shared liquidity, you have a shared asset that anybody can bring to their users through a front end. Whether that front end is regulated or unregulated is sort of a um, irrelevant question for this exercise. But the point of having sort of shared underlying back end infrastructure that can be globally enabled actually provides unbelievable composability and liquidity opportunities. And to me, that is one of the single most exciting and interesting components of the programmable economy and bringing assets on chain. I think it will democratize a lot of things. Asset management is a good example of it. I think it will actually also enable, and this is one of my things I've been saying for 10 years. Whether or not it will ever happen is remains to be seen. It hasn't happened to date. And I'll tell you why. I think part of it is I actually think it will return the world a lot to a meritocracy. What I mean by that is it will be much easier for, particularly in sort of the trading space, for people to prove their value on merit as opposed to sort of whether they went to Harvard or they've worked at Jane Street or if they've worked at Citadel, purely as a function of what they've been able to build on chain. This hasn't been true historically for two reasons. The assets that live on chain with enough liquidity haven't been interesting enough. Like, there's only so much you can do trading purely crypto native assets. The second is that the RWAs that have come on chain are still not moving at the velocity of on chain assets, right? It's not easy to permissionlessly take a money market fund. It's not easily permissionlessly to take with significant liquidity tokenized equities today. I think we're probably still multiple years away from that. But you can even see, for example, in the perp space, right? People are tracking traders. People are looking at alpha. So there's a question around, should this be private? Should it not be private? I think that's, again, another sort of orthogonal, interesting philosophical question. But I do think that this will lead to a ton of democratization, which will lead to an improved meritocracy. It's one of the things I am most excited about by on-chain primitives, because if anybody in the world can tap into getting exposure directionally to any asset in the world at any time of day, package a collection of these assets in any way they want and represent them in a derivative token, for example, it is so much easier to see what that could unlock. I also think you can see much more creative investment theses being played out programmatically. And that's another area that I'm extremely excited about. You look at, for example, and I've seen teams doing this today. They're using a combination of AI or just like other sorts of primitives, where you can do some of this off chain. To be clear, you don't need on chain primitives to do this. I think Robinhood's doing this in their trading. But if I want to just say, like, it looks like there's a lot of tension in the Middle East. What is the investment thesis I should have? Just build it for me, right? You can the amount of primitives that might be available to you, again, enabled by a shared backend infrastructure with liquidity for every asset being pulled from any jurisdiction. It's like unbelievable the amount of opportunity that could be available to design systems that way. We're starting to see it more on the debt side, I think, than on the equity side. What I mean by that is, if you look at sort of, and we're seeing these sort of genres of business models pop up a lot. Athena started it, I would say, with the basis trade. How do you package the basis trade into a single synthetic asset that anybody can speculate or bet on and earn yield? USDAI is doing this for GPU lending, where they're lowering cost of capital, increasing diversification, representing in the form of a single stable asset. Again, I'm not saying there aren't risks associated with lending against debt collateralized by GPUs, but you're seeing the democratization and the creativity that can be generated by this shared backend infrastructure, in these cases represented by sort of synthetic assets, stable synthetic assets. You're starting to see it play out more quickly on the debt side than on the equity side. But I think that as traditional assets move more quickly on chain, which I think is like the real goal, right? Like, obviously you both work at Wisdom Tree. I think it's probably less exciting for you to say, again, I don't want to speak for you, so correct me if I'm wrong. We should just tokenize assets that just live on a blockchain if they're going to never get fully integrated into permissionless. Again, whether those permissionless actions, and we could talk about how we think about this on the Arbitrum side, permissionless doesn't mean there isn't a regulatory or compliance layer that sits on top of it, right? You might have to build a permissionless regulated environment. It might just be sort of where your regulatory framework internally works, but the ability to tap in and utilize the asset is, I think, a critical thing. For me, I would love to see every asset live in a permissionless environment for everybody in the world to be able to tap into. Obviously, I don't sit on the issuance side, so I don't see all the complexities, but that's my vision for the programmable economy. It's starting to take form. If you look at what's happening with stable coins, which we sort of like to coin as big programmable money, the last 5 years, I think, has heavily skewed towards the velocity of movement of stablecoin assets. I think the next 5 years will see similar progress, but on non-stablecoin assets that move on chain.
Yeah. And I couldn't agree more. I think you made a lot of good points there. And to your point on the the compliance side, at least, that's something that Wisdom Tree has been trying to innovate on. I think there are limits to what we can do given a lot of our assets, and Deville can chime in on her side. But I think access point and democratization of finance is something that we we say a lot in why we're doing this on chain. I think it starts there, is the ability for anyone around the world to get access to these products. I think is step one of that innovation. But to your point, composability, what you can do with those assets, that's definitely the next phase of what we're working on. And I think, I know we're running on time, but in terms of 2026 then, right? What would you say is your focus points of all the great things that you guys are working on between Robinhood? I know you guys also had recent acquisitions. What is your 2026 and beyond focus?
Yeah, it's a great question. So for us, our focus, um, Arbitrum has always sort of been heavily focused and off chain as well on DeFi. That's been our sort of bread and butter. Like perps as a category really was kind of born out of Arbitrum. If you start with GMX, Hyperliquid, a lot of these started their early journeys on the Arbitrum platform. For us, right now, it is how can we think through the connective tissue between the issuance of assets into on chain primitives, right? So for me, it is insufficient if assets move on chain. It is insufficient if the trading venues that live on chain can only trade crypto native assets. We need to make sure that all of us can talk to each other. It's why at Offchain we acquired ZeroDev, which is a smart account platform. We want to think through the policy compliance layers, the UX layer of enabling this connective tissue between the issuance of what we call RWAs and the primitives that can enable the programmable economy. That is our focus in North Star. The Arbitrum platform is very flexible. Obviously, we have the public Arbitrum chain, which is the home to a ton of DeFi innovation. But you can also launch your own chain, like what Robinhood said, which was like what Robinhood did this past month. And for me, and I think what's unique about Arbitrum, really in the market, is we have both of these products: a public permissionless chain and the ability to very heavily customize your own chain that are market leaders, right? A lot of organizations or teams have an SDK to launch your own chain, but their public chain sort of might be sort of less liquid, less tooling, less assets, less DeFi primitives, etc. Because we have both, when I talk to an organization, Robinhood's a great example because Robinhood was on the public Arbitrum chain until they launched their own chain. We want to understand how can Arbitrum and our product suite generally solve your problems to bring them on chains. I don't want to come with a solution and say launch your own chain, right? I want to tell Wisdom Tree launch your own chain until you're ready and that makes sense from a product perspective, if you should do that. What I want to understand is what are your business needs, what are your business concerns, and how can I solve it? And I want to make sure that we continue to develop our tools and our products to be able to answer those questions. How can we solve them? And if you're sort of sitting within the contours of I have assets that can live within the programmable economy, I think the Arbitrum platform is most uniquely situated to support you in your present and in your future as you continue to scale your on-chain business. So continue to do that is our core focus for how we want to be able to support our customers.
Incredible insight and fascinating discussion. And to conclude, I'm sure you have had to say no to potential partners or opportunities. What was the hardest no in your whole life in crypto space?
Yeah, so I think there's two classes of things that we've had to do. Um, and I'll walk you through. I can't speak to on the first one, I can't speak to the specific deals, but one of the things that happen in crypto is that a lot of blockchains are presented with opportunities for very large enterprises and organizations to work with them. And like sometimes the economic structures of these deals might be favorable, it might not be favorable, etc. But many times the way we've thought about this is how do we ensure that Arbitrum can remain sustainable and grow, right? So we've been very prudent in how we've structured our discussions and conversations with partners to make sure we have long-term sustainability. And one great example of this, which is sort of, I think, has manifested itself and has been very helpful, and I think will be extremely helpful to Arbitrum into the future, is the Arbitrum source code is licensed using the modified version of BSL. So I'll tell you how it works, because we've had very large organizations and institutions ask us to waive this. And saying no to working with these organizations in order to waive this is very, very challenging. And the reason why we haven't said no is because we want to make sure that we can defend the business moving forward. So I'll give you an example of what I mean. This is how the Arbitrum license works. The public Arbitrum chain is obviously free and permission. When I say free, you can utilize it for your business. Obviously, you have to pay transaction fees, but there's nobody stopping you from utilizing it. And this principle of being permissionless to use was very important for us, especially as organizations want to launch their own blockchains. So today we have about 100 teams that are using Arbitrum technology stack to launch their own chains. And the question is how do we monetize this and have this be a vehicle for sustainability as opposed to a mechanism where we just cannibalize ourselves through our partners who might have more distribution than us, right? So if you look at crypto and you ask yourself, and we get this all the time, how is these large organizations using the Arbitrum technology stack, what's going to happen to Arbitrum? How is Arbitrum going to succeed in the future? And for us, we want all of these organizations to feel like they can use the software. But we want to make sure that we will be here for the next 10, 20, 50 years to make sure we're retaining enterprise value and being able to invest in the software. So the way the license works like this. If you want to launch your own layer 3 blockchain on top of Arbitrum 1, that is permissionless and free. And the reason for that is because I want people to be able to do that. So a lot of teams have done this. EdgeX, which is one of the largest perp platforms, they have an L3 on top of Arbitrum. Ethereum is a perp platform, it's an L3 on top of Arbitrum. And the value to Arbitrum is the only way to get into this ecosystem is through the public Arbitrum chain. And all those transactions settle to Arbitrum 1. So you can kind of think of the economic benefit of like, okay, I'm reinforcing the public Arbitrum chain as like Grand Central Station. And all of these different things weave into it. That's one. There's a lot of teams, though, that don't want to launch a layer 3 blockchain. They want to launch a layer 2 blockchain. I want to permissionlessly enable that. How can they do that? If you launch a layer 2 blockchain using the Arbitrum technology, there's very little sort of structural value that accrues back to the Arbitrum token holders, to the Arbitrum technology stack, etc., other than a case and proof point. So what we did was we did what we call the Arbitrum expansion program. If you want to launch a layer 2 on top of Ethereum, you want to launch a layer 3 on top of a different layer 2 technology stack. For example, there's plenty of Arbitrum chains that settle to base. People don't realize they're Arbitrum chains, they are. So you want to make that permissionless, we want to make that enabled, but just give us a 10% profit share. That's it. If you pay us, right, it's a simple 10% profit share. You don't have to sign any contracts. You don't have to speak to anyone. You can simply just use the technology, integrate the fee splitter. 10% will flow to the on-chain to the Arbitrum DAO treasury. You can keep the other 90%, then you can move on. If you want to get your own negotiated license, you can go submit a proposal to the Arbitrum DAO. To date, nobody has done it because it's much easier to just follow one of these two paths. That, though, was probably the hardest no, because there have been teams and organizations in the past that have asked us to waive this as a mechanism for them to use the software. And for us, it was hard to say no to these organizations. But at the same time, again, we try to find other ways of working with these organizations or structuring a deal with them. But waiving that is something that's very challenging because this is a core part of Arbitrum's thesis, which is the business model will remain sustainable. We are focused, this has been one of the themes of our conversation. We are focused on creating a simple and intuitive, sustainable business model so that the technology can continue to advance and evolve and grow alongside its customers instead of purely being cannibalized by its customers. And that's not because our customers are malicious or they're trying to hurt us, but if you set up the incentives in a way where they can just take the software, they don't need to work with our organization or work with, then that's what they're naturally going to do. They might even have a fiduciary obligation to do that, right? The feedback we've gotten from our close partners, to be honest though, is that most of them don't mind paying this 10% fee. Because first of all, if there is a free version, if they wanted to take a free version, but second of all, they have comfort knowing that there is sustainability and that this software will exist and it will continue to be improved on for many years to come. If you're a large enterprise that is building your on-chain business with us as the backbone infrastructure, it's not very comforting to know that we might go under because we didn't build a sustainable business model. So we actually have gotten a lot of positive feedback, but there have been, transparently, some painful no's along the way in order to be able to enable that business.
Fascinating point. And yes, I fully appreciate the point that institutions want long-term perspective, and they want to make sure that the people and the individuals and the organizations they work with will be there in the future when they need them. So thank you so much for your time today. It was a true pleasure talking to you, and please keep in touch as further things are built out.
Of course, thank you for having me.
Thank you.
To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Offchain Labs and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.